Good evening, friends, and welcome once again. On this day two, we have a celebration also going on in India. Lohori, Sankranti, Makar Sankranti. There are so many names, but the festival is the same. We all are celebrating here, and also we are learning about the UAE tax laws. Yesterday, we had a fantastic session with Vice Chairman Sir, Harikishan Sir, Pratik Sir, Ankur Sir, and again today we have three fantastic panelists today with us. CA Jai Prakash Agarwal sir, Treasurer, ICAI Dubai chapter. We welcome you, sir. Thank you so much for accepting our invitation. We have Tirupat Mehta sir, Founder, Managing Partner, Vice Consultancy. We welcome you, sir, and thank you so much for accepting our invitation. We have the backbone of this entire two-day session, CA Nirav Shah sir, who has entirely programmed this session for both the days. Nirav Shah sir, Founder and Managing Director, Film Advisory, DMCC UAE. So thank you so much, sir. A special thanks and again thanks for the wonderful session you have drafted and you have curated and have finalized the topic as well as all the details as well. So thank you so much once again. So friends, we have without wasting much time, would like to tell that a few people have missed day one, so they can watch on our YouTube channel, and we will share the presentation also. Will also already received from panelist that's presentation, and also there are pending also from one of the panelists or two of the panelists. Then we'll combine all the 2 days and we'll send to all the attendees as well. So today first we'll start with Jai Bhai. We welcome Jai Bhai. Would like to, it's my proud privilege to introduce CA Jai Prakash Agarwal sir, who is a rank holder chartered accountant from India and also holding a UAE with 18 plus year of experience across industry ranging from consultancy, technology, telecommunication, manufacturing and healthcare. Sir is also a golden visa holder and is managing partner at Smart Info Park and MC Management Consultant. He is also sits on the board of Dubai chapter of the ICAI. He is presently a treasurer at the chapter. So biggest and most vibrant overseas chapter.
Virat, can't hear you.
More than 3,000 plus chapter as a member registered, Virat. But as in more than 5,000 member. So he has been a past chairman of Dubai Chartered Accountant Student Association as well. He is also recognized tax and compliance faculty for the Institute of Chartered Accountants of India, conducting regular training for fellow chartered accountant and have trained more than 800 plus chartered accountant on taxes and compliances. Sir has also conducted seminar in Abu Dhabi, Dubai, Sharjah, Ajman and Ras Al Khaimah and many other cities. His article on the subject have been published in Khalij Times, the longest running English language newspaper in UAE. His experience is not only limited to pondering on compliances, but is also a business process and technology consultant who is involved in designing of efficient business process and deployment of different applications. So with this brief introduction, we welcome you, Jai Bhai, and would like to request you to take the proceeding ahead for our today's session. Your keynote address, your brief on the topic. So over to you, sir.
Thank you, Virag. It's a pleasure talking and interacting. I've seen yesterday's session, and that was power packed. And after that power packed session today, it's tremendous pressure. I was calling Nirav Shah in the morning. I said it's a tremendous pressure after seeing how exactly they handle the sessions, the entire 1.5 hours, 2 hours. It will be a challenge for us. So we'll try to live up to it. Let's start. You heard about VAT changes yesterday. You heard about opportunities for chartered accountants from Hari Bhai yesterday. Today we will be covering on corporate tax. Yes, with me there are two stalwarts who will be talking on corporate tax. We'll take you through what exactly is there in corporate tax for you in the published law by the authorities. What my role is, in my next 10 minutes, I will try to tell you with corporate tax coming in, what is going to change, what we were doing earlier in terms of business, and now how exactly the business will start changing. Okay, and I understand from Virag that most of us are chartered accountants from India. We are Indians and we are more filmy. So my presentation today will be more on filmy style as to what changing for corp businesses due to corporate tax coming in UAE. Let's start. My first thing is what will change. When I was thinking, I said Kagaj. If you remember, there's a movie called Kagaj where this man was trying to prove that yes, he's alive because the birth certificate was not there. There was a death certificate. If you have seen, people will be able to connect, and who have not seen it, to summarize that this person, he was live and he was going to authorities to establish that he is live, and don't depend on the paper because there on the government papers he was already declared dead. So Kagaj was required for him, and same way for UAE authorities. What will change for businesses? Improved financial documentations. They have to start working on documentation. I'm not saying that UAE, as in UAE we were not following financials, we were doing financials, we were having documentations, but the problem was we need more efficient documentation going forward. We might be following IFRS, we might be following US GAAP earlier, we have to follow now. So again, let's look at the documentation, let's look at our financials to ensure that we are complying with globally recognized accounting standards. Why? Because you will hear from Mr. Nirav Shah that yes, in corporate tax, authority has said please continue to follow any of the global accounting standards. They have given you the flexibility. The flexibility is to either follow IFRS or US GAAP or any other thing, but you have to follow one of the accounting standards. So relook into the documentation, relook into your financials to ensure yes, you are complying with the same. Segregate personal and business expenses. My dear friends, when I say segregation, I do not mean that it was not getting followed, but yes, that was getting followed uh, by a niche class of businesses, but there are SMEs as well. But now with SMEs coming in, the corporate tax coming in for the SMEs, yes, they have to segregate. I have seen, my friends might have seen that there was a lenient approach regarding segregation of personal and business expenses. The personal expenses were also getting reported in financials because there was no corporate tax. You are not shifting money, you are not taking any money out of government pocket, you are just reporting your numbers. So personal expenses, even if you book for SMEs, you don't have a bank loan, you don't have to submit the financials anywhere, was working out. But now with corporate tax coming in, this segregation will be more important to ensure that we are in compliance. So that is where the readiness has to come. That is where they should start looking into their financials to understand yes, all our business expenses, nothing relating to personal is there. And as you all know, VAT was 5 years, and then again it has been increased. Now for city, they have again re-emphasized that the records has to maintain for 7 years. Earlier, record keeping was limited. With VAT, it became 5 years. Now with corporate tax, the period is getting extended 7 years. So improve financial documentations. Otherwise, what will happen? You end up proving that you are alive, your business is, the numbers which you are reporting are fine. That is the reason I said keep that kagaj to ensure that you are alive. You are alive does not matter. That what matters is the documentation, the paper which will establish it. That is my point number one, that with corporate tax coming in, start looking into your financials and improve them. What is second thing? I say Naseeb. Naseeb was a movie you have seen. So I said, don't let it, let me just minimize this. Yes, don't let it to Naseeb. Why? Because now when corporate tax is coming in, what you have to do, you have to start looking into org structure. Org structure, because there is a concept of tax grouping. Okay. In VAT, if you are from UAE, if you were following UAE VAT from 2018, you know there was something as tax group came in, and many entities who had multiple organizations, they went for tax grouping, and there was advantage, there was synergy which they can see when they went for tax grouping. That tax grouping is not same in corporate tax. It is completely different. It's more of a holding subsidiary, and that too with 95% holding. But even again, don't go blindly. My request to business, you have the law, you have seen 25% holding in a holding subsidiary, you can go for a corporate tax group. But should you go for it? You should not go for it. Wait for it. Nirav Shah will take a session, we'll have a slide to show you that you have to evaluate whether you should go for tax grouping, whether you should not go for tax grouping. Again, spin-offs, whether spin-offs are possible or not, you have to review it. But my dear friends, when you're reviewing the spin-offs, that okay, I will take one structure out of my organization and keep it as floated as a separate company, do look at economic synergies. Do not, it should not come as city avoidance. If it is established that the spin-off is just to ensure that you end up paying low corporate taxes, then it will be penalized. Because right now, as we are speaking, the law is published and GAR is applicable. What is GAR? GAR is General Anti-Avoidance Rule, that you are not doing any structuring, in a way to avoid corporate tax. So you have to have that economic justification. Wait for it. I mean, don't let it on Naseeb, but also understand when Nirav Shah will be speaking that what exactly that is. He'll be covering that portion, I guess, at least at the broader level, that it is applicable. So you have to look for economic synergies, but time is now. The second thing is, first look at the kagaj. Second, don't depend on Naseeb. Start looking at your org structures and reevaluating whether you want a tax grouping, whether it's advantageous for you or not, or whether you want a spin-off and that is backed by economic synergies or not. That is my second point for being readiness. Third is hum aapke hain kaun, the classical movie, and why I put this slide of Hum Aapke Hain Kaun, because there is a concept of related and connected parties. You from India, all the people who are sitting from India and attending it, you already know why related and connected, not connected, but related parties are important for you. You already know about it. I don't have to tell you. We have brought the same concept, related and connected party. Till now, we were doing transactions related and connected party, but now first thing is to list down all the related and connected parties up to fourth degree of relationship. That is more important. Why? Because all these transactions, when you have identified that these are the transactions done with related party, you have to go for TP documentations. My dear friends will understand. That is why start looking at your customer base, your supplier base, and see whether it's a related party or a connected party. Connected party includes owner, director. It's a enhanced version, right? Director and their relatives are also included in connected parties. So that is why I'm saying hum aapke hain kaun. Look at your relations and try to find out who are related to you and for what you may need TP documentation. At least you should know with whom you are doing transactions. That is my third part. Fourth, okay, before going to fourth, when I say fourth, if you look at the tree, I will go a little fast here because I only have 10 minutes. You and your spouse, this is your first degree parent and your first degree is child. Okay, if I go to second degree, I will say you and your spouse, child, and child ke baad pota kisko pyara nahi hota, grandchild comes in. If grandchild is coming in, you will see grandparent comes at the top. Okay, again, this will not end my second level. If I am born, just let me see. Yeah, if I am born to my parent and my parent has childs, then they become my brothers and sisters, and they also become my second level. So my second level is three parts: grandchild, grandparent, brothers and sisters. Similarly, a great grandchild becomes my third level, and on top, you know, by now I will show you above grandparent, great grandparent, and this will not end here. I am to my parent. My parent is born through my grandparent, and if my grandparent has other children, that becomes my aunt and uncle. That becomes my third level. And that is not the end of it. Me born to my parent has kids which are my brothers and sisters, and they have kids which is niece and nephew for me. They are also my third level. And similarly, fourth level, I will not spend time. I will just show it on the screen. So see the hierarchy. I think the way the life is getting shortened, I think everyone is covered there. So you have to look up to fourth degree of kinship. And only one thing, this is not only up to you, this is covering your in-laws as well. So look at both sides, on the top side with your family, and the affinity side on your spouse. So it's really large relationship. Look at those parties and connected parties. Moving on, I give you third. One was kagaj, maintain documentation. Second was Naseeb, look at your org structure, don't let it to be Naseeb. Third is hum aapke hain kaun, related and connected party. Fourth, I give you Drishyam. What is Drishyam? If you remember, justify your story of 2nd October. That means what? Kickstart your TP documentations. One is you have identified your related parties and connected parties. Kickstart your TP documentations of master and local file, because in UAE we have not seen it. In India you have seen it, so you have that experience. If you have any UAE entity, you have to kickstart that TP documentation part of it, because you will need that for submission whenever authority requests for it within 30 days. There is some kind of I believe that there will be a relief coming in. I'm waiting for some cabinet decision where there will be some relaxation for TP documentation. We have to wait for that, but it will be required. So let's start working on that and have that story built in. So 2nd October becomes my real story, which comes through master and local file. Last slide is special Shabbos. After you have done all the stuff, after you are ready, you have time. 2023 is your time. Have a mock run. Why mock run? Because that will help you to establish how exactly you will be reporting your numbers in 24. If you have a calendar year, as a financial year, you have 24 as a reporting period, which you will be reporting in 25th. So 23rd can be your mock run. Please plan your mock run, run the reconciliations, look at what is allowed, what is not allowed, so that you can understand what exactly the city cash you have to keep aside for paying the corporate taxes, because it's not a collection from a customer, it's going from your pocket. So you have to provision that as a cash flow, and also have a third party review. Like in Special Chabbis, Mole was sitting within the group, so better to have a third party view completely from outside, so you don't get trapped and you don't get robbed of your money. So that's third party review for you. So 5 pointers: expected changes after corporate tax. What will come in corporate tax, yes sir will cover, but what exactly you should do: improve financial and documentations, revisit org structure, list all your related connected parties, kickstart TP documentations, and finally in 2023, please mock run your CT computations to arrive at what exactly the cash flow can be, and that will also give you a learning lesson and how to report in 24 numbers in 25. With this, I have done. This is what my expectation is. What will change in business in UAE? Now I'll go back. I'll just kill this slide and see if any questions are there.
No, sir, we don't have a question as of now. Would like to request all the attendees to post your question in the question tab. We have all the faculties till till end of the session. They will reply in the from the question tab as well. So thank you so much, Jai Bhai, for a quick review and a fantastic session, marathon session, and a very interesting way to connect with the movies and explaining. So it will be remembered for a longer term. So thank you so much, Jai Bhai. Once again, before I introduce our next panelist, Nirav Bhai, would like to request all the attendees. So whatever question you have, you can post in the question tab, and we have a Jai Bhai who can answer, or we can take a later also. So you can post all your question in the question tab. So for entire overview of corporate tax, we would like to invite CA Nirav Shah sir, Fame Advisory DMCC. So sir is the founder and managing director at Fame Advisory at UAE, Dubai and UAE. Sir is a qualified chartered accountant from Gujarat, and being an excellent academia, sir is a secured 6th rank in inter CA and 36 rank in a CA final. So sir is a rank holder in both inter and final. Then sir moved to KPMG in Mumbai and has been specialized in international taxation and finance, and advising on various cross-border transactions from international and domestic tax and regulatory perspective. Sir is a skill help companies do set up right corporate holding structure for the group, evaluation of a new business or investment opportunities, strategic input reviews for business, and managing compliance issues as well. Sir has more than 20 plus years of experience, from own practice to leading consultancy firm to working with large family-owned corporate group. Sir has hands-on experience of establishing and managing structure and compliance in more than 12 jurisdictions, evolving suitable corporate structure for holding companies, acquisition of business finance and IP optimization structure, establishing suitable family structure for asset protection, succession planning, efficient ownership, and valuable experience of operating in multiple jurisdictions. Sir has successfully conducted VAT training for Dubai SME for our institute, the ICAI Dubai, G2 Jain International Trade Organization Dubai, and Indian Business and Professional Council Dubai, to name a few, with a total participation of around 1600 plus professional who work from 550 plus companies coming from 7 Emirates of UAE. So with this, and he's also a full-time member of Society of Trust and Estate Planner as well. So with this introduction, we welcome you, sir, and thank you so much for accepting our invitation and creating this entire webinar structure and finalizing the panelists as well. So thank you once again, and you can share sir screen as well now, and
Yes.
you can take the proceeding ahead.
Sure.
Over to you, Nirav sir.
The screen is visible now?
Screen is visible, sir.
Yeah. So thanks a lot, Virag, first of all, for giving the idea for organizing this. And therefore, we put together on both days eminent experience panelists to take you all through the, most of the key points as far as VAT as well as today corporate tax is concerned.
Sir, just want to add that we have thousands of candidates who is applying for our campus placement. What ICAI is announced international campus placement, and there are 100 of vacancy also already listed on the website of CMIB Institute website for campus placement, and there are few of them also attending our today's session as well. So just this input, and over to you, sir.
No, sure. So definitely, UAE is the market right now, and people are looking for right skills of candidates. So you can definitely try and explore that further. Okay, so today we are going to talk about the new corporate tax law which is coming in. These are some of the items that we will go over and talk about it. More fundamentally, from an Indian point of view, and what you should remember, and thank you, Jai, for doing a very nice introduction so that people connect very easily as to what is now going to change as a fundamental ground rules. We are going to take you through some of the technical provisions, but let me tell you this way that, of course, UAE is introducing corporate tax now, and we have taxation system in India for now 60 odd years, right? And internationally, they've looked at whatever are the provisions in different parts of the world, whatever are the beneficial or necessary provisions across the world, and most of them you will find here in this law. So you can talk of any concept under taxation, be it PE, be it nexus, be it transfer pricing, be it thin cap regulation, be it transfer pricing. Of course, I mentioned participation, exemption, carry forward, and set off of losses. Everything is available within this small compact law that they are proposing. So yes, it's small and compact, and it covers a lot of concepts, and therefore we'll go through some of this. But more interestingly is the approach. So when you compare with India, the approach here is very, very different. Here, the government is, and we'll go to that why they are introducing, so that you get a perspective of why the structure of the law is such. So UAE started introducing all this legislation in last 5 years. We started with VAT, then we had economic substance regulation, we had announcement of corporate tax, and now of course the law has come in, and law will start applying from 23. But one must understand why. So the trigger, of course, is the OECD's BEPS project, and once BEPS started, the OECD wanted to include more and more countries to implement the BEPS provision. That's when it started going out of its 20 or 30 main core members and include more and more countries to implement their proposals, where the idea of the inclusive framework came about. And UAE is one of the signatory to the inclusive framework, and that's how OECD reached to almost 140 countries to be part of the inclusive framework, where they are saying that, okay, don't, so we have 15 action points, don't put everything into action. You may just do 4, which is the bare minimum, and we want everybody to be on board with that. So 2018 around is when UAE signed for that, and as part of that signing of inclusive framework, some of the commitments were given to introduce different compliances in the economy, and that's why we have seen all of this changes which has come in. Now, interestingly, for a country which did not have corporate tax till now, UAE has negotiated and signed over 130 tax treaties, and of which over 100 treaties are active and in effect. So even before it had no taxation, it was very interesting jurisdiction to use for multinational and still avail some of the treaty benefits while keeping the margins of the profit legitimately in UAE in compliance with transfer pricing and other things. So if you keep this to connect in mind, what comes up is that here you have a country which is bringing in corporate tax now, but it already has over 100 plus tax treaties, and it's coming more as a pressure from OECD. So as we say that it's more about commitment to meeting international standards, about preventing harmful tax practices, And of course, it's also a basis, because if you want to implement the pillar 2 and you want to collect the minimum tax which OECD is proposing, you need to have a mechanism. So that mechanism comes in form of a corporate tax regime. So combining these three aspects together was the need for UAE to introduce this law. Now, since the law is not coming from a revenue pressure, so UAE GDP per capita, there's no deficit. It already is earning from its natural resources and other trades, and therefore there's no revenue pressure to bring in taxes. And therefore the entire approach of the law is very, very different. So in India, if you are treated as I would say culprit till the time you prove yourself innocent. Here the approach is slightly different. They say, no, you are innocent. If we find something wrong with you, we will treat you as culprit. So the entire onus of proving that is on the tax authority. And therefore in the context of the law here, if you see, it's a self-assessment mechanism. Therefore the onus is on the business to do it correctly. In 9 out of 10 cases, or in majority of the cases in the initial years, they won't be questioned, because it's not that everything will get picked up for audit and so on and so forth. But as a corollary to that, what happens is what we have seen with VAT also, and I'm sure you would have heard yesterday, is that the penalty and the interest and delayed interest and the penalties are very high. So if you do the default, you are subject to a very high financial penalty and also criminal consequences if it is intentful. But you are encouraged to comply the law as far as possible. So there is a deterrent in place, but apart from that, the onus is on you to do it right, and they trust you in a way. So that's very fundamental in trying to understand the approach in the law, So that's why they come up with a rate which is only at 9%. That too above the income of 375,000 dirham equivalent, which is about $100,000 equivalent. So up to $100,000, anybody earning that much of net profit, there are no taxation anywhere. So it's at 0%. Only above that is taxed at 9%. If you look at entire GCC, this is the lowest rate of tax. And even if you look at worldwide, this is second or third lowest, because there are very few countries which have, one has a 5.5%, one has 8.5% tax rate, and the 9 is the third lowest almost. After comparing the countries which has corporate tax regime, of course those who does not have, we are not taking that into account. So they ideally tried to do it in a manner that they're bringing in the law, which is wide, which is as per traditional corporate tax law. However, the rate is lower in the world, and therefore it remains competitive from a UAE's attractiveness perspective to keep attracting new businesses to come and set up here, right? So the rate is at 9%. Now, the important part here is that unlike India, where you have a fiscal year or a tax year which is defined as April to March, here there's no specific tax year defined. So each assessee can choose its own tax year in a way. So whatever is its financial year that it follows for its own accounting purposes, that becomes the tax year. And you don't have to artificially align everybody to a single tax year. So it's a dynamic process. If you are following calendar year, for you it is calendar year, and therefore any financial year that starts after the June of 23, the tax year starts at that point in time. So for different assessees, the tax year will start at different point in time. And this table kind of gives you an idea on that. If you're following calendar year, your tax year will start from 1st January 24. If you're following April to March like India, it will start from 1st April 24. But unfortunately, if you're following July to June, then it will start immediately on 1st July of 23. So there's no fixed year that is thrust upon you to follow. You can follow your financial year, and tax year will follow that same period. Now, who are covered? So like any corporate tax, first we need to define who is resident and who is non-resident, because residents will be taxable on their worldwide income, non-resident will be taxed only on their source income, right? So any legal person incorporated or established in UAE is by default resident, including the free zone companies. Natural persons who are conducting a business are covered as a resident person and therefore taxable on the business income that they earn and not on the personal income. So it's not income tax, it's corporate tax. But if you are doing a sole proprietorship certain businesses, then those businesses will get caught under the corporate tax regime. And foreign entities, if they are effectively managed and controlled in the UAE. So your concept similar to the place of effective management concept in Indian tax law is also there in the UAE law, where it defines that it's also to be a resident person. So for non-resident, if they have a PE in UAE, so permanent establishment concept is defined, fixed place, and we'll go into the detail soon. And if they are earning the UAE source income, so state source income, which is defined similar to Section 9 in Indian Income Tax Act, and they've kept this agenda open to prescribe any of the nexus related condition, because as you know, OECD is debating a newer mechanism to expand the source base because of the digital presence and other things, where you don't have physical presence and still you are doing a lot of business with the country. So the nexus is the concept which is debated. Of course, India is ahead. They already implemented significant economic presence in our tax law as one of the nexus. So similarly, if OECD tomorrow finalizes any nexus rules, UAE tax authority will have option to introduce that as part of this definition of nexus. So that also is kept open. If some of that comes up, then the authority can define that also in this portion. Okay. So taxation, it's a residence-based corporate tax regime. So your local domestic residents will be taxed on worldwide income. But for a natural person, the scope is limited to its business activity that they do in UAE. So technically, if I am an individual and I have a business in say US, and I've set up a company there and is doing something and I'm a shareholder, then I'm not directly taxed, even though I'm a only shareholder, I'm a sole proprietor, but I'm not directly taxed for the US business income here. But if on the contrary, I have a business here in UAE and that business earns anything, even though it is in individual capacity, it will get taxed in UAE. So again, very typical concept, but one needs to be careful with that. Non-resident, of course, are only taxable to the extent of the source, which is in UAE, and not anything else. So any income which is sourced from UAE will be taxed either in with the PE or generally, right? So these are the basics of taxation. Then just to let you know what is defined as source, like our Section 9 when it is deeming fiction and few other things. Here the concept simply is something that arises or accrues or is earned from UAE. So any income derived from UAE resident person, any income derived from a non-resident person where it has been paid or accrued in relation to or in connection with the PE in UAE, or if that income is coming up from an activity which is either performed in UAE or is in relation to asset located or capital invested or rights used in UAE. And they also expanded that to cover services performed or benefited from UAE. So any service related income is by default regarded as UAE sourced income. Again, there are a few other miscellaneous category of sale of goods in UAE, provision of services, right to use the IP, insured assets being located. So for insurance companies, if the insured assets are located in UAE, then that also the premium for that will be taxable or will be deemed as a sourced income. And if borrower is resident in UAE, then the interest income that is earned is also deemed to be sourced in UAE. So again, it's wide, but it's not creating the deeming fictions like we have few, and therefore it's basically about earning income from UAE or anything which is accruing or arising in UAE, right? So it's not as wide as Section 9, but it's akin to Section 9 provisions. Permanent establishment concept, I'm not sure how many of you are aware, but as per the OECD guidelines, so this entire concept is now brought into the domestic law here, that if the foreign non-resident has a PPE either through a fixed place, which in the form of a branch or office or a project site, and that if that project is carried on for over 6 months, then that becomes a fixed place, and that gets covered as a permanent establishment, and it excludes, of course, the preparatory, auxiliary, or only stocking for distribution kind of an activity. A dependent agent who has an authority to conclude contract also gets covered as a permanent establishment, or any other form of nexus which can expand this definition going forward, right? So that's again standard OECD concept, but again they brought it up very clearly, like you see in various treaty commentaries. Whatever is regarded as P internationally is already covered and brought in as a part of the domestic law itself. So typical to any of this, so we have a list which is on exemption side. So our exemption are few and not very many. Okay, so of course the government and government entities are exempt for carrying on the government function. Entities which are wholly owned and controlled by government is also exempt, and then businesses which are engaged in extraction or any of the extractive activities are taxed separately. So if you are in oil and gas sector and you are getting you are doing the extracting business, those businesses were always taxed by a Emirati or state level decrees. So in UAE we have 7 emirates. So each of those 7 emirates used to tax entities which were engaged in such oil and gas extraction businesses, and they continue to pay the emirate level taxation. So that has been retained, and they are now exempt from the corporate tax, and it's not a dual charge for them. So any of these entities will continue to remain in the emirate level decree and subject to tax at the emirate level, and they will not be subject to corporate tax. And similar to our provisions in India, the ATG kind of thing. So if there are charitable institutions, if there are public benefit entities which are prescribed in a cabinet decision, then those will be exempt. Investment funds will be exempt because we want to give them a transparent status. And public or private pension or social security funds are also going to be exempt. So these are again very specific, very limited 7 or 8 items which are on the exemption list, and not going to be very exhaustive kind of a thing. Next, just a second. Yeah. So free zone, there are specific guidelines, and I'm not going to deal with it in detail. I'll ask Tirupat, my colleague, to go into the detail of this, because again, this is very interesting. The entities which are in the free zone has certain benefit, and Tirupat will kind of take you through in detail on that, while I take you through the remaining part of the law. So again, compared to any other country, the computation of this taxable income is very, very simple. It will follow your financial statement. It will allow you to follow your own accounting standards. It will allow you to have your own accounting policies for depreciation, amortization, and whatever. There are no separate adjustment on that side. And it will follow any 12-month period for which you prepare financials. Okay, and that becomes your tax year. And it starts with your accounting net profit or loss as per financial statement. And there are only few adjustments to that. So we'll talk about those adjustments now. So there are items which are exempted. So exempt income, and again this is with a view to encourage investment activity which is being carried on locally. So only investment holding and other type of activity will continue to have the benefit that dividend and capital gains are going to be exempt categories subject to certain conditions. So All domestic dividends from any shareholding held domestically in any of the UAE based companies are exempt without any conditions. For any foreign dividend or for any capital gains, which is from the sale of shares, they all are exempt subject to meeting the participating interest condition. So this is very simple and very similar to the participation exemption conditions which are found very frequently in European countries. So what it says is that there are three conditions which one needs to fulfill. That if taxpayer holds more than 5% of the ownership interest, if it is hold this or has an intent to hold it for at least a 12-month period, and the investee is again a company which is subject to tax at a minimum rate of 9%, which is similar to UAE. So if you meet all of these conditions, then any dividend or capital gain that you earn out of this investment that you made will be exempt, and therefore it will not be included as part of your taxable income, and you can reduce your taxable income, your accounting profit or loss by that amount, and only do the adjustment for the balance part of it. Interestingly, for the foreign branches of the UAE companies, they have given two choices. So you have a choice to offer that to tax in two ways. One is that either you offer it to tax as part of your main entity and you claim the credit of the foreign taxes that you may have paid on it, provided that branch has been subject to tax. So provided that branch has been subject to tax and has paid those taxes, you can take a credit of that. Now, if you think that the branch has paid more taxes than 9%, then the parent company has a choice that it will choose to exempt this entirely. So it will also not include this branch's profit or loss into its own computation and deduct it or adjust the taxable profit with that, and say that, okay, my this income has already suffered more than 9% tax and therefore I'm not including it. So that option is also available as far as the foreign branches of the UAE companies are concerned. Okay. And then of course for non-resident who are operating or leasing aircraft or ships, so basically for airlines and shipping lines, it remains an exempt category, because of course internationally they have been treated as such, so corollary treatment is given in the UAE corporate tax also. Now when we come to deductible expenses, and you all have seen section 43 and few others and a lot of this disallowances in Indian computation, here it is very simple and very straightforward. So everything which is wholly and exclusively for the purpose of business, you can deduct it as long as it is not capital in nature. So any revenue expense you can deduct it freely. Now some expenses which are not allowed, which are like donations or grants which are given to non-qualifying public benefit entity. So if you are given donation to any charity which is named as such in the cabinet decision, no problem, that's fully allowed. But if you end up giving to some charity in India or wherever, then that's not allowable from a UAE corporate tax point of view. Similarly, if there are any fines or penalties, then that's not deductible. If there are bribes, then that's not deductible. The dividend and profit distribution of course are on capital account, and therefore it should not be claimed as a deduction, and they explicitly mention that. Interestingly, so any payment to your connected person or related parties is first non-deductible to the extent that you justify that they are at the market price or at arm's length price. You can claim it as a reduction. So anything that is over and above that will remain non-deductible, right? So that's the very limited segment on what is not allowed. There are only two expenses which are subject to limitation, as we say. So entertainment expense, where you have incurred those expenses in relation to shareholders, suppliers or customers, then that is restricted to be deducted only up to 50%. And second is the thin capitalization rule, which we find internationally also, and which we have in some form from an Indian point of view. So interest payments are capped at 30% of EBITDA. So if you have net interest expenditure in your book, and if it is more than 30% of your EBITDA, the excess will not be allowed as a reduction. On the other hand, you have an option of carrying forward that excess to next 10 consecutive years and set it off in the year in which you have the gap between the 30% of EBITDA and the actual interest expense. If your actual interest is less than the 30%, then in those years you can set off this excess which you could not claim as deduction earlier, right? And of course, if the loan is, if you want to become smarter and give loan from shareholder and again then take it out as dividend or you know, other capital payments, then this assisted payment loan interest will not be allowed. So again, this is an anti-abuse provision, which also is commonly found in a lot of jurisdictions. So except this two, there are no other limited deductions available, and only those which are non-deductible is what I have already mentioned to you. There is very interesting provision about the grouping, as Jai was mentioning. So here in UAE law, if you are part of the same group, you have an option to choose whether you want to be taxed as one single entity. So there are of course pluses and minuses, but first we'll look at what are the conditions. So you can group it only if the parent and subsidiary all are in UAE and there is 95% or more control through shareholding, voting rights and profit entitlement. So all three conditions needs to be satisfied, not any one of them. It is applicable only to the UAE based parent and subsidiary, and in that group you cannot have an exempt person or somebody which is taking the free zone benefit or anything. You cannot include that as part of the group. Okay, all group members has to follow the same financial year, and the taxable income of the group will be determined at a consolidated level, and therefore it will eliminate the transaction between the group, and there will be a single tax return file, right? So I'll just explain you through this example that if I have a holding company and which holds this percentage in A company, B company and C company, then in the first example, which is on the left, the company which is with 75% holding cannot become part of the group because it is not meeting the 95% threshold. Now when we go to the second example on the right, all the companies are above 95% threshold, but the C company is in the free zone and is claiming the benefit of the free zone tax system, which Tirupat will explain. If you are claiming such a benefit, then also you cannot be part of the same group. That's something that is very important for one to evaluate whether you can or you are eligible to be part of the group or not. The second thing that you must look at is what are the benefits of grouping. Do you have any benefits? Then you group, otherwise what's the point? So if you are taxed individually, you get the threshold, as I mentioned, of 375,000 dirhams, which is taxed at 0%, right? But if you combine, the threshold is available only once. So effectively, if you are both profitable company and you combine it in a group you'll end up paying more taxes. So whether there's a benefit or not is something that one needs to understand that in detail. But on the contrary, if you have losses, so one entity is incurring losses, the other is making profit, then if you group it, it's going to be very beneficial, because then at a group level you will pay much lower taxes. Further, if you group it, the other advantage is that your intercompany transactions are eliminated, and therefore if there are all related party transactions within the group, then those also gets eliminated, and therefore your transfer pricing compliance on those also is not applicable. So you might want to group it just to avoid detailed documentation from a transfer pricing point of view. So that could also be another motive. So now we turn our attention to provision for losses and carry forward of losses. Okay. So here it's very interesting that losses which are incurred after the corporate tax regime comes into operation, and it is from not from any asset or activity which is generating exempt income. So normal business losses after the year from where the corporate tax applies, it's allowed to be carried forward indefinitely without any restriction. So you have indefinite availability of those losses. However, there's a cap on in each year how much loss you can set off. So if, for example, in the first year I have losses of 10 million and or 1 crore, and if I have next year profits of 2 crore, I can only set off 75% of 2 crores, which is 1.5 crores, only to that extent. So if my carry forward losses are more than 1.5 crores, then I cannot set off that. So it's more like a provision of having an alternate minimum tax. That minimum 25% of your profit you will pay tax on, irrespective of your losses situation which you have. And only condition that you need to fulfill is similar to what we have in our Indian law also, that shareholder continues to own 50% of the control or capital. And even if there's a change in ownership, the losses will be available if the underlying business is same. So these two conditions, if they are met, then either of that condition being met, you can carry forward the losses to that period, to indefinite period, and you can set it off in the next year. This is a very interesting provision, very beneficial and pro business, but of course subject to the minimum anti-abuse provision that one needs, you know. So now when you are in the group or when you have common control, there are some special provisions. So as a group, you will get relief on any intra-group transfer of assets or any restructuring or merger or anything, as long as the condition of 75% of the common shareholding or ownership interest is there. So here the word is ownership interest, and direct or indirect ownership interest. Whereas if we look at the earlier provision of tax grouping, the condition was 95% shareholding, voting rights, and profit entitlement. So very specific condition for grouping. However, to get benefit of the tax, the relief within the group, so here the condition is a bit more wider. It is direct and indirect ownership interest up to 75%. So if you have that, there's a very unique provision in the law. So if you are not in the part of the same group also, and there are two entities, so one is incurring losses and other is profits, and if both have common ownership of 75%, you can effectively transfer the losses of the entity into the profit making entity in the same year, of course up to the 75% of its taxable income. But this is unique because without grouping them, you can actually claim and set up the losses within the same year without having to carry it forward within the same entity for next period, you know. So again, some other common condition that none of them should be an exempt or free zone person and should follow the same financial year, and those things has to be there. But if it is there, you can actually set off the losses within the common group entity without putting them in as part of a group for tax purposes. So again, this is very interesting and very different provision, which again is not present in many corporate tax provisions. Now I turn my attention to transfer pricing. So India transfer pricing rules define associated enterprise, anybody having more than 26% ownership interest, and then of course related parties and all that gets covered. However, here there are two aspects. Like Jai mentioned, the related party definition is up to 4th degree of kinship, which is very, very wide as compared to the Indian definition of related parties, you know. So India definition of related party is specific to 1st degree. Here it is up to 4th degree, and here the threshold is 50% or above common control and not 26% like India. If you fall within that ambit, and I'll take you through the definition of related party and connected party because that's very interesting. What one needs to understand is that it covers domestic as well as international transaction, because there is no individual tax or personal taxation. It's very easy for somebody to move profit from corporate to individual. So with a view to create a deterrent, they've included also the domestic transaction within the transfer pricing, that all related party and connected person transaction has to be at arm's length, and that arm's length has to be then justified. And of course, we'll have threshold above which you need to do detailed documentation. But those justification and the documentation, as you know, is a cumbersome process which is already in place in India and a lot of other jurisdictions. That same thing is being introduced here also. So I mean, simple example, why do you have a transfer pricing? Because you cannot pay whatever you like. You can only get deduction up to the arm's length value of the transaction, and therefore in both cases, post the implementation of corporate tax law, the deduction available will be only up to the arm's length value of the transaction. Related party, as Jay mentioned, 2 or more individuals related up to the 4th degree of kinship, having 50% or more share capital or control, or any combination of that. So if it is legal entity owned by those related parties having common control, or it's a mix, individual and entity, or the branches of them, or 2 or more partners in same unincorporated partners, everything gets covered. So all sort of permutation combination is what is covered in related parties. As I said, the definition is very wide, so that one needs to be careful about. Like Jai explained, so this is up to 4th degree, up to great grandparent, and therefore your first, second, third level cousins all kind of get included. The definition of control, like we have in India, is also very wide. 50% of voting rights and about 50% of profit or 50% of board director. Anything that you can control is regarded as a control definition. So this both points one needs to be careful about when they start planning. There's interesting concept of connected person also, where if you see in the yellow box here, any director or officer is also regarded as a connected person, and therefore transaction with any director or officer who does not even have any ownership interest can also trigger the transfer pricing compliances. And then the related party of those director or officer also are covered within the same ambit. So that's why this regime of transfer pricing has a very wide coverage, and plus it covers domestic and international transactions. So transfer pricing is going to be a bigger headache for a lot of corporates going forward than even compliance mechanism which is otherwise there. Standard 5 methods which is accepted worldwide for OECD transaction, which is all OECD prescribed. Your transactional method, your profit method, CUP, cost plus resale price, transactional net margin method, and transactional profit split method. So all of them is accepted. And if you can reasonably say that, okay, none of this applies to me and there's a 6th method which is more suitable to me, I can also go and apply to the authority to accept that another optional method also. But this is more or less standard in comparison with international practices, and there are no surprises here. Documentation, so like India, where you have to file a 3CEB along with your tax return, here also there will be a requirement to file a disclosure along with the tax return, which is relating to transaction with related parties and connected person. Business has to maintain local file and master file, in addition to submitting that every year, the disclosure form along with the return. We don't know whether that needs to be certified by an independent person or not, but that will get notified in the rules. But like other transfer pricing requirements, local file, master file, all documentation needs to be submitted within 30 days if it is requested for. And what is important is that it applies from now, because you require to have an opening balance sheet which is prepared, taking into consideration the arm's length methodology and the anti-abuse rules. So what it does is that you need to start following that practice in the current year, because they don't want an inflated balance sheet to be your opening balance sheet, where you then go in the next year and start claiming either fictitious or bad debts or increased depreciation or so on and so forth. So if those artificial adjustments are made in the current year balance sheet to take advantage in the future, then those could easily get disregarded through transfer pricing as well as general anti-abuse rules. So both are already in operation, and one needs to be very careful of whatever changes that they want to do in this year or from any time now. This is something that one needs to bear in mind very clearly. General anti-abuse rule. So you all are aware of the GAR in India, It's similar. The provision comes in effect currently as we speak. So what they would say is that any transaction which is undertaken with only a view to avoid tax payment, or to do, so to say, a tax planning, or to get a corporate tax advantage in any manner, and it does not have any other valid commercial reason for doing it, then the tax authority can counteract it, it can ignore it, it can adjust the transaction, and it can look through the corporate veil, and has all the power similar to Indian tax authority to adjust that correspondingly and tax that amount which you try to save. Now what they've done is that as soon as the law has been published, they have said that within 15 days of the law being published in the Gazette, the general anti-abuse rules are already in operation from now. So if you do anything from now to change and suit your businesses in a way that you save taxes, then all those, if they do not have any commercial valid reasons, that could be potentially disregarded by the tax authorities if they go into the details of that. So this is very, very important to follow from now, and be careful of why you are changing, and do you have a valid commercial reason to do any change, or are you doing it only for tax purposes? If you're doing it only for tax purposes, mind you, that can come back to you and haunt you later, you know. So like I said, the computation and the compliance here, unlike India, is very, very simple. So if you compare on a scale of 10 to 1, if India has a complexity, and you can say it is the most complex or similar to, or say if 10 is most complex and you rate India at 8, this will be rated at maybe 2 or 3. So you start with accounting net profit. You, as I mentioned, the few adjustment on exempt or non-deductible part, that straight away gives you a taxable income. There is no adjustment for depreciation, amortization, or other things, you know. So all those are just not there. Only thing is that if as per your accounting standards, you have certain unrealized gains or losses, then those also to be adjusted along with the non-deductible item, which are notional in nature, then those can be ignored. So that brings you to the taxable income, and then you can claim you can compute the tax amount. If you have any foreign tax credit, like you have suffered any withholding taxes, or on your branches you have suffered or paid taxes in other countries, you can claim that to the extent of the 9% rate. So I'll just give you an example of how the foreign tax credit will work. So foreign tax credit is tax paid in foreign jurisdiction that shall be allowed as a tax credit against the UAE corporate tax liability on the same income. So the maximum credit that is available is either the tax paid in foreign jurisdiction or the 9% tax which is liable on that. Lower of the two is allowed as a foreign tax credit. And any unutilized or excess credit that you have, that will be lost. You cannot carry it forward or carry back or claim it. So if, say for example, a UAE company is receiving payment from India, and under Indian withholding, you are deducting withholding tax at 10%, right? So that income, when it is taxed here, you can only claim the set off of that withholding tax up to 9% tax liability that it has, or the effective tax liability that income has. And if only to that extent you get the credit. Fortunately, they have provided for withholding tax mechanism that any UAE source income is subject to withholding taxes, but currently the rate proposed is 0%, and there are no withholding tax returns to be filed or anything at the moment. Of course, this will come in future, so that the broad structure is very much available for anybody to go through that, you know. So tomorrow, after 3 or 4 years down the line, government can bring in, instead of 0, will make it 5%, or for different source of receipt, it will be different percentage. You know, like we have different rates for dividend, interest, royalty in the treaties. Similar they can do in future, but they have kept that provision in the law from now. So this is just to give you an example on the foreign tax credit, that if you have a foreign income of 200 and there was already a 15% withholding, then you already suffered 30 as a withholding tax. However, the 200 is taxable at 9%, so that maximum tax on that is only 18. So you'll get credit of 18 out of that 30, and the 12 will be lost. So that's how the foreign tax credit computation will work. Like I mentioned, the compliance procedure is very simple. Everybody will need to register, including free zone companies, and then one is to file its return only after 9 months from the end of the financial year. So if your financial year ends on 31st December, you have to file the return by end of September next year, and you have to also make the tax payment at that time on or before that date. So again, it's all very simple. It works on a self-assessment basis, and fines and penalties and all will come in. But like we have seen in VAT and other law, it works on the same basis. Okay. So overall, we say yes, the records are to be maintained for 7 years under corporate tax law. There will be a requirement to audit, but which entities and who needs to get it audited, that the rules will specify. There is an option to file for private clarifications for your particular situation where you think that the law is not very clear for you to apply. You can go and ask the tax authority for a clarification, and they will provide, and also advanced pricing agreements you can do. Of course, the mechanism and form and manner of doing it will get specified in due course. There will be a simplified compliance obligation for small businesses. They are going to provide certain threshold, which below which the businesses will have simplified compliance further to this. So overall, I would say that transfer pricing is the main issue that we have. It is very positive that there are very minimum adjustment between your taxable profit and the tax and the book profit, and therefore we may not have to do a lengthy calculation, but it helps to introduce the general anti-avoidance rules, and therefore one needs to be careful of how you deal with it. Otherwise, the law is very simple to apply and take it up. So I will now we request all the companies to start getting ready, do the impact assessment and do the training and adopt this. Okay, so before we go into that, now I'll request Virag to introduce my colleague Tirupat and take you through the provisions which is in relation to transfer pricing, free zone person, which is very unique to UAE tax laws. So Tirupat will deal with that in detail, and then we can of course come back to you for Q&A session. Thank you all. Virag.
Yeah, thank you so much, sir, Nirav sir, for the fantastic session, and thank you Jai Bhai, who is replying on all the questions. So there is very minimum unanswered questions. So thank you Jai Bhai. It's my proud privilege to introduce our next faculty, CA Tirupat Mehta sir, who is the founder and managing partner at Wise Consultancy. Tirupat Mehta sir is a chartered accountant with more than 25 plus years of experience in providing fiscal, strategic, and operational leadership in finance, taxation, and audit field. With his vast experience of working at different senior management positions in corporate world, he started his boutique corporate advisory firm, Wise Consultancy, in 2011. He is a finance professional with rich experience in hospitality, oil and gas, shipping, FMCG, healthcare, real estate, pharmaceutical, petrochemical industries, and advising his client across Middle East, Southeast Asia, Sub-Saharan African, and APAC countries for setting up of companies and projects. With his expertise in financial planning and analysis, he specializes in raising structure, trade finance, vessel finance, project finance for SMEs and large corporate. So with this small brief introduction, we welcome you, sir, and thank you so much for accepting our invitation, sir. So over to you, sir.
Thank you, Virag, and thank you, Nirav Shah, for giving such an explanation, detailed explanation about the UAE law. And thanks, Jai Bhai, for taking us to the Bollywood movie at the beginning. So we have a Naseeb, we have Hum Aapke Hain Kaun, and now with that Naseeb, that people have landed opening free zone companies in UAE, as UAE is the hottest destination. So everybody is interested to know about what it means about a qualifying free zone person, how we can maintain the zero tax status for the qualifying free zone person. I'll give you some interesting facts about the qualifying free zone. what are those free zones? How many free zones are there in UAE? As you know, there are more than 40 free zones in UAE, and UAE holds more than 600,000 odd companies. And of that, 12% or more are free zone companies. That means we are talking about 70,000 odd free zone companies. And most of the investors, they open free zone companies to avail the 0% corporate tax, 100% capital repatriation, 0% capital gain tax. So there are a lot of advantages which the free zone companies have been offering in past, and people have been opening companies in the free zone, and they have a dilemma whether that status going to remain the same or it's not going to remain the same. That's the challenge among the free zone companies. Now the UAE corporate tax has also implemented that they will be taxed. Yes, all the companies registered in UAE will be taxed. At what rate? At 0 and 9. Now, what qualifies 0 and 9? That's what someone has to look at it from the law, from the transactional point of view. So free zone companies, to be qualifying as a qualifying free zone person, what are the conditions? Which one need to look at it so that you qualify as a qualifying free zone person. We'll see what are the definitions of a qualifying free zone person. You need to maintain adequate substance. Now, adequate substance means what? We are taking that the companies which are registered in UAE, they need to maintain adequate substance. Definition is not yet defined under the CT law, but however, we'll take reference from the economic substance. That most of the companies in UAE, which are free zone companies, are open based on a flexi desk basis. Correct? There are no employees. There are no office. There is no email IDs. They don't have a website. So most of the companies are running on a very skeleton basis. Now, how do you justify your transactions? That's where the economic substance will come. You need to maintain your adequate substance to prove that the profitability is maintained. So that's one of the major important conditions, that you need to maintain adequate substance. Now, they should be deriving the qualifying income. What is the qualifying income of a free zone entity? Now, that qualifying income is not yet defined. We are waiting for the announcement, the fine print of the law. However, as a qualifying income, we need to understand that the income should be generated from doing business outside UAE, typically if you talk of, and that will be under the qualifying income. Normally, if you see from a VAT perspective, any merchanting trade, what happens between, or a third port shipment trade happens, they are out of the scope under the VAT. But however, they may fall under the scope of, under the scope of taxation under the free zone. Now, what are those kind of transactions? We can discuss in detail. But yes, so the qualifying income, what will comprises of is yet to be announced. But if you see from other jurisdictions like Mauritius and other free zone, those kind of jurisdictions which are earlier tax havens and now they have converted, they're saying that the income should be generated from outside the UAE, from outside the jurisdiction of the corporate, where you are registered. Now, they should not elect for taking 9% exemption, to claim the threshold exemption. So the free zone company, if they opt to claim as a normal corporate tax of 9%, then they should not opt for it to remain as a qualifying free zone person. They should meet arm's length principle and transfer pricing requirements, which Nirav has already explained. What are the arm's length principle and transfer pricing requirements when you deal with related parties or connected person? They should meet all those principles, and the documentation for those need to be done, or any other condition which may be prescribed by the minister and the cabinet decision later on. But the first four are the compulsory, which they need to maintain to qualify as a qualifying free zone company. And what are the advantages of that? We'll look at later. Now, failure to meet any one condition disqualifies the free zone entity to be a qualifying free zone person. Now, what will be the disadvantages of not being a qualifying free zone person? We'll run through it again. Most of the free zones, they offer 0% corporate tax for 50 years. When you form a company, you get those things that under the impression that you are under a 0% corporate tax incentive period is offered. Now, these laws will also be get amended as we go forward, and we'll see. Maximum period of exemption is 50 years for any free zone, and that can be only extended up to another 50 years. But again, that need to be evaluated once the executive regulation or clarifications will come, based on what are the free zones. Another important point one need to know is that the definition of free zones as per corporate income tax is not yet defined. They've been defined under the VAT, but not defined for the corporate income tax. So that means we still need to await what free zones will qualify under corporate income tax, because there are designated free zones and there are non-designated free zones. So that will have an impact on your planning once we see that that will come in place. Now, if you see from a tax point of view, what are the tax rates for free zone person? If you are a qualifying free zone person, that means you comply with all the 4 conditions, then your qualifying income is taxable at 0. Straight, you are having a 0% tax level. And if you are on your non-qualifying income, will be taxed at 9%, but you will not get the threshold exemption of 375,000. That will not be available if you claim yourself as a qualifying free zone person. You don't get a threshold exemption of 375. Your non-qualifying income will be taxed straight at 9%. And if you choose to be as a non-qualifying free zone, then you get the exemption of 375. So up to the profit or income up to 375 will be taxed at 0, whereas your any income over and above 375 will be taxed at 9%. Now, as we see that's the difference. For a normal, there are mainland companies, they are straight away taxed over and above 375 at 9 and below 375 at 0. Whereas the free zone person have the option to choose between the two, between a qualifying and a non-qualifying. Now, if you see from what are the benefits, what are the things what a qualifying free zone person cannot claim. Now, you cannot claim threshold exemption. You cannot claim, you cannot be a part of a tax group or a qualifying group, which again, Nirav has explained that on the transfer of losses and other stuff, you will not be eligible to claim onto the benefits of a tax group or the benefits of a qualifying group and the associated benefits related to the tax group and the qualifying group. You cannot claim. Cannot transfer or offset losses to or from a taxable person. So under the qualifying group, there's a provision where 2 people can transfer the tax losses for certain conditions. That will also not be available for a qualifying free zone person. So one has to evaluate and see what is beneficial for him to choose as a qualifying free zone person or to choose as a non-qualifying free zone person, depending on the group structure or depending on individual tax liability. Now, if you see from an angle that most of the people in free zone have a lot of questions about their capital gains onto their investment. A lot of free zone companies have been formed to hold investments further down, in other countries. So again, that was covered under the partial exemption, participation exemption, in terms of where you hold shares in foreign companies, which should be more than 5%. By explaining, you should continuously hold that for more than 12 months or intend to hold them for more than 12 months. So you will be getting those exemption under to be a qualifying free zone person. Still, mainland companies also hold qualifying free zone person. If you have a group company within mainland and a free zone, you're holding shares, then you can hold those shares. But again, the conditions of that group need to be participation exemption need to be met. What a qualifying free zone person, all free zone companies, whether they have business, no business, activity or no activity, they need to be registered. They need to file for the registration. They need to file the tax return. They may be asked to file another, in terms of related to documentation, related to transfer pricing, documentation related to arm's length principle, all those kind of documentation may be asked for. Again, most of the free zone companies, free zones are asking financial statements, audited financial statements to be submitted, but there are many free zones, again, they are still not asking for the audited financial or certified financial statement. The corporate tax has left the decision with the assessee to see whether he wants it to be audited, or we see that further regulations when it comes, what will be the requirement to be an audited or a certified public statements need to be submitted or not submitted. Now, in terms of when we talk about the income, the burning issue of free zone entities, because their profit, which has been generated through businesses within UAE, this is where the transaction advisory or transaction assessment need to be done. We need to assess what is your business model, whether you are doing business, whether your income is generated through a UAE sourced income on a concept of a UAE source basis, or through a payment mechanism. If you're receiving money from UAE entities for a transaction which has happened outside, you have raised invoices to the local entities, and you're receiving money from here, but the goods are moving out and out. So those kind of transactions will fall under the category of non-qualifying. And on the qualifying side of income, we assume that all the transactions which are outside, that will fall on those category. So free zone qualifying free zone businesses have limitations as far as to taking the advantages of threshold exemption, tax losses of group law, tax grouping, and other grouping. Otherwise, all those businesses which are in a free zone, they should be happy in terms of they will still enjoy 0% corporate tax, provided they maintain within the framework, within the guideline of, and they restructure their trade or restructure their transactions, they will still continue to enjoy the benefit of 0% tax. I think from my side, this is on the free zone. We can take it on the questions because there will be a lot of queries based on transaction or holding basis. So we can take that subject based on that. I think I'll leave to Jaibai. You can take it.
Thank you, Tirupat sir. Now it's time for some Q&A, and I think we have already answered many questions. Tirupat sir, you can take out the PPT so that the PPT is not required anymore. And now it's your time. We have deliberated what we learned or what we have planned for it. Now it's your time to ask questions. I have a couple of questions because I will take this opportunity to ask questions to the stalwarts. It's very difficult to get Nirav and Tirupat in the same call and ask them questions to get their time. So today, since I have the opportunity, let me ask the first question. In the meantime, you can ask your questions on the chat and I'll pick up from there. Okay. My first question is, Tirupat sir, you were very clear in your presentation. Let me take first question with you. That qualifying income has not been defined, and we have to wait for cabinet decision or a executive regulation to come in to define that qualifying income. But from your experience, what will be qualifying income? Will it include everything which free zone is doing it, or they will try to restrict something? What from your experience will qualify as qualifying income, which we should expect for free zones?
As I explained, in a free zone, the tax liability is based more on the transaction basis, and income you derive based on your transaction status. So qualifying income, to me, it will be any business which has been done outside from a buyer or a seller will qualify for as far as the goods are concerned, right? In terms of your income through sale and purchase, and your supplier is in India, your buyer is in Africa, and any income which is generated to that will qualify as a qualifying income, which will be taxed at zero. Any income earned on that will get a zero related to sort of tax liability. That should be the criteria as far as the goods are concerned. Okay. And similarly,
Please go ahead.
Yeah, and other thing is, even on the transactions which are merchanting trade transaction or third port shipment transaction, we should see that it should not be UAE sourced income. You should not have a payment linkage on one leg to be based in UAE. That either you're buying from somebody, but you are selling it to UAE entity. That should be avoided in terms of, provided if it's a free zone to free zone, then that will also be a qualifying income. Should be. Once we define the free zone definition, any transaction between two free zone entities may also fall under the qualifying income, provided we know the definition of which are the free zones which will fall under the definition. So that can be done. These are the three things I would say one should look at it as of now, which will keep yourself safe from being rooted. And Nirav can also show some light into it in terms of what will be a qualifying.
Nirav, what do you think? I mean, you have something to add on what should be qualifying? I know law will come out and that will be the truth, but as from your experience, what exactly should be further added to this?
No, so basically one needs to read the law in its entirety. If you look at UAE sourced income, it already covers services having performed as part of the UAE sourced income, and therefore unless there is a specific carve out, all service entities which are in the free zone also may not get that benefit at all, right? So one needs to look at what can get covered and what cannot. But like Tirupat said, we do believe that mostly the trade related income, which is primarily from trade outside of UAE, will definitely get that benefit.
Perfect, makes sense. I can see few questions coming in, sir. Ask your questions related to corporate tax. Tirupat sir's number, Nirav sir's number. This will be freely or easily accessible. You will be able to get it. So I will skip those parts. I will go to technical questions which you have asked. Sharing of PPT, please. These are not your technical questions. You will get it. These are general questions. Let's go to what exactly is there any tax audit provision in UAE? Nirav sir, you talked about yes, tax audit can be there, but are there something with they're targeting in terms of tax audit?
So unlike India, we do not have the 44AB kind of tax audit provision here. What is mentioned is that you will be mandatorily required to have audited financial statements for certain category. Because just to clarify to everybody that in India we are used to having a mandatory audit for all the companies. This is not the case in UAE. The audit is mandatory only for certain which are in certain free zone, where free zone makes it mandatory for you to have audited financial statements for your renewal and for other things, you know. So that's why the law prescribed that for certain category of taxable person will make the financial statement audit mandatory. So like we had seen in the consultation draft, it was made mandatory for those who are availing, say, free zone benefit. For them, it was going to be made mandatory. But of course, that we have to see in the law and the regulation of for whom it will be mandatory. But it's just regular financial statement audit. No specific tax audit is required. No.
Those normal audits which you are carrying out in UAE will suffice. Right now, there is no mandate like above this threshold you have to go for a specific tax audit report. Nothing like that we are seeing it. And I think Tirupat sir, you have the same version, or you want to add anything on that?
Same. They've kept it open at this point. Even the audit is not, they've kept it mandatory at this point.
Okay, one question, Nirav sir, you talked about thin capitalization, which is coming from OECD, and you linked it very well to interest, 30% cap on EBITDA. 30% EBITDA is the interest cap. Okay, one thing which is coming to my head, because with IFRS 16 in place, there is interest portion which is reported in the financials. Now, when we are looking at 30% EBITDA, are we have to include all the interest, including this interest of lease portion as well, to compute that 30% cap, or this will go out, this will not be considered?
So technically it is actual interest expense and interest income that you look at. IFRS 16 adjustment is more notional, and it's for the different purpose. It's for more disclosure to give you right kind of liabilities assessment of the business, and not really to impact the P&L as such, you know. So I do believe that the notional adjustments of the accounting standards will need to be ignored, and only the actual tax, I mean interest payment or interest income, is what you take into account when you compute this provisions.
Okay, makes sense. I'll not ask this question to Tirupat sir, because I mean we were in some other forum and I have already asked this question, and his views are same with as Nirav, that yes, it will not be there, it will not be considered together. But I have a different question for you, sir. The question is, if you go through the interest deduction portion, there is a provision saying in ministry may come up with a specified amount or a cap for interest other than this 30% EBITDA. So are we trying to say they will again put a higher cap other than 30% EBITDA? So 30% EBITDA may be coming to 2 million, and they say no, I cannot allow 2 million. I will again put it a upper cap of 1.5 million or 1 million. Something like that we should expect in cabinet decision, or you think no, it will go as 30% EBITDA right now?
For general, it will be 30% EBITDA. There may be special cases where the capitalization is very high, high capital intensive, organizations where you have a lot of capex need to be done, and interest cost is much higher than your EBITDA in terms of. There may be some government, they may come up with that based on the feedback, I would say, in terms when the practicality will start. They may come up with that kind of cap or a caveat, which will allow for certain type of industry or certain type of companies, in terms of. But as of now, I think it's a 30% EBITDA. The main effect people will be either of a higher capitalization and a lower turnover on that, or good traders, which have a high volume of trader with high, bank loans, and they might have they will not be able to absorb the entire, in terms of interest they have to carry forward. So their cash flow might get impacted as far as the interest is concerned based on those. So certain evaluation need to be done.
Makes sense. I mean, that means they are just keeping a power in their hand to introduce that cap for some industries if required. One interesting question is coming from Jitendra Bhatia. We all know Jitendra Bhatia, sir. I hope you are doing good. You can always call us and ask this question, but for the benefit of all the audience, Nirav sir, this question is to you. We know there is a provision in resident person that foreign companies effectively managed and controlled in UAE will be called resident person and will be subject to city. His question is theoretically looks good, but how will you practically achieve it? How as UAE you will be able to control those entities because they are sitting outside, they're just getting managed from here. How practically it will be applicable to them to get them registered and pay city?
So yes, there are practical challenges, but like I mentioned while I was presenting, that is similar to the place of effective management concept in India also. How it gets reported. So India, every Indian company has to report its foreign entities. That's why it gets reported in India. However, UAE does not have those requirements. So you don't report everything. But today we are living in the world of CRS and information exchange and all that is very, very common. Now, where does that information come from? And then they start asking you is a separate aspect. Yes, it's not easy or it's not easily or directly available in today's format. But say, for example, if you are required to file an audited financial statement for your entity and you have mentioned 3 or 4 entities which are your subsidiaries outside, they might ask you from that, leading from those kind of information that you file. So yes, it's challenging, it's not directly available to them, but if they want to find out and they have those information available, they'll keep asking you those questions.
So it's difficult, but yes, they will find a way out. We have seen UAE evolving; they are using more and more technology. So Jitendra ji, be rest assured, UAE handle kar lega. They will be able to handle it. Okay, a question which is coming in, it says, if a company of India make any kind of transaction with its subsidiary or related party located at free zone in UAE, then what is the impact of city? So you have a free zone entity or subsidiary sitting in free zone and Indian entity is doing a transaction. How does city impact both the companies? One from India perspective, second from UAE perspective.
So Indian company has Indian transfer pricing and Indian taxation exposure anyway, which I'm not going to kind of expand on. However, when you do transaction with your subsidiary, you'll have to be at arm's length. Then that subsidiary, whether it is eligible for a free zone benefit or not, is a secondary question. If it is eligible for a free zone benefit, that income will be taxed at 0%. If not, it will be taxed at 9%. But transfer pricing, documentation, and justification of that is mandatory in all cases.
Okay, makes sense. When you talked about that 375 cap is not available if you don't have a qualifying income, and I think I have heard Tirupat sir covering that part in his presentation as well. So are we saying this question is to Mr. Tirupat? Are we saying that this 375 benefit is not available to free zone entities because the moment you are having a non-qualifying income, how does it pan out? Whether it will be they will not get the benefit at all for 375, or whether on the non-qualifying income they end up paying 9%.
Yeah, so if you are a qualifying free zone person, if you opted for a qualifying free zone person, then that benefit of 375 is not available. So your income on the non-qualifying income will be taxed straight away at 9% from the from the start level. Yeah, so you will be taxed at 9% on the non-qualifying.
Non-qualifying will be 100% taxable. You will not get the relief because you are getting the relief on the qualifying part. You have opted for it. Makes sense, sir. I'm okay with that. I know I'm running short of time. Virag, I can see the eyes of Virag and say, Jay, complete that portion because we are running short of time. I have one more questions, and it is regarding Nirav sir. There was one provision I remember in the law. It says there will be some kind of relief for SMEs. Okay, and when I go through it, I'm not able to connect what kind of relief we are talking about. We have already given a relief of 375, up to 375, it's 0%, right? Then what kind of relief UAE law is talking about, which we can expect in cabinet decision on executive regulations?
This could be even related to the transfer pricing. So small business who does not need to comply with transfer pricing, you will have a threshold which will get specified. So it may be related to that, but we'll have to wait for the cabinet decision to see what exactly it is for. But we do expect it is more going to be from a transfer pricing point of view. That if they will say that okay, if your related party transaction, say 5 million, don't get into all this transfer pricing janja. Do what you want to do. We don't care. Yes, things like that.
Okay.
But also, if you see, we are given a small business relief is there as a package, where again the revenue is not yet announced. You know, what is the threshold of the revenue where you have to file the tax? You know, you're not liable to pay the tax if your income is below that threshold limit, which is yet to be announced. So that's the SME sort of stuff where they might come up with $500,000 turnover or $1 million dirham turnover. They might not be in terms of. So that is another one which can be, you can look at it from that angle for a small businesses.
It can be both. As per Tirupat sir, it can be a turnover based limit, saying if you are doing a turnover of less than 5 million, 2 million, you are not required, you are getting a small SME relief, and it can be a TP documentation as well. We'll look into it. Tirupat sir, this question is for you because you are doing audits, lot of audits in this market. What type of audits corporate have to face in UAE? Stat audits, internal audits, TP audits, VAT audits, or anything other than this?
All sort of audits, I would say, because the laws are not synced in terms of you have a completely VAT is completely a different law, your tax grouping is different, your that assessment is different, and CT is in a different zone, right? So you may still have now we have a custom audits are in place, correct? That people are doing custom audits, custom is taking on those statistical audits are being taken care of. Then you have your VAT audits which are coming in and need to be taken. And now when you see on the corporate tax, you have those. And then you have the assessment on ESR and anti-money laundering. So all kind of compliances based on your activity and the subjectivity, you will be. So keeping aggregate books of accounts, understanding of the law, and having the right advisor on your side is the key to run the show in UAE now.
Perfect. So audits will be, I mean, not all our audits are right now mandatory, but you will see audit getting mandatory for TP audits and even for corporate tax audit. Maybe there is an opportunity. One question which I think everyone knows about it, but since Ketan is asking, let me put again to our panelist. Is there any income tax on salaried person in employment in UAE? So if the person is on employment, whether he's covered for income tax right now? No.
Individual person only covered in relation to the business that they carry on, not for personal income, salary income. Those remain outside the purview of corporate taxation.
Perfect. So Ketan sir, you can come to UAE, do job. You don't have to pay taxes here. You can enjoy that money if you are taking a salaried thing here. Okay. One more question from India perspective. There is something called ROC, Register of Companies, and NAFRA is again authority in India. Is there any similar authority which you are seeing in UAE which plays the role of ROC or a NAFRA? The question is to both panelists. Let Nirav Shah go first.
UAE is very typical. So whereas in each country you just have one ministry which register the companies, we have some 45 here. We have 40 odd free zones, then we have 7 odd mainland which all register companies. So they all are ROC in their own way. So we don't have to deal with one, we have to deal with multiple where you are registered. Okay, so each one has their own different corporate laws which are not which may not be very similar. Some are very exhaustive, very modern, has different provision, others are not, and they only allow you equity shares and few other things. So you need to be very careful where you set up and how you set up, and therefore it's not just a single ROC. You might end up complying with different where you are registered. So, and it all could be very confusing.
Tirupat sir, your take on the same?
Yeah, I agree with Nirav that there are so many free zones and so many authorities which are, but what we have seen of late is that everybody is coming up with shareholder registers, board meeting registers, and they're linking it to Ministry of Economics. Slowly there's an integration which is happening between the free zones. All the free zones are getting integrated with the Ministry of Economy in terms of so that you have a standardization of document. Currently they're all in a fragmented manner, but slowly this is happening. So I believe by June all the free zones will be compliant to have, because we are getting a lot of emails for maintaining your registers, like as a CS work, company secretarial work is also going to increase as far as keeping those. Yeah, so that is also an opportunity.
So right now we are in decentralized mode. There are a lot of authorities which we are dealing with. There is no single ROC, but as Mr. Tirupat said, yes, there is work of centralization going on. We will be reaching there, but it will take some time. Right now we are working on decentralized mode. I'm looking at my calendar. It says 7:44 here, which is almost like 9:14 there. And now it's time to hand over to Virag. Virag, over back to you. We have addressed most of the questions there, and thank you very much. Virag, back to you.
Thank you, Jayabhai, for the wonderful moderation and asking all the question on behalf of attendees. And thank you, panelists. Only just one last question, or basically a discussion point, that all the updates regarding the taxation or VAT, UAE corporate law, where the attendees can find. I mean, there is any book, website, if you can give references that.
Essentially, if you want to look at law, you go to Ministry of Finance website. In the legal section, there are all the laws and notifications and all are there. But there's no textman like publication like the Pratik and all mentioned yesterday. It gives you one book which covers everything. No, maybe we'll come up with something, some compendium like that. Jaibai Institute should take the lead. We can help you with that, not a problem.
We can do that. But in meantime, what you can do is you can also go to tax.gov.ae. That's the website, and there you'll find the law in black and white. And please go through that. That is more important. And in meantime, we'll work on some documentation from ICAI perspective and see if something can be brought in for all our members.
See, just to draw a parallel for VAT, you have the law and you have all the notification and guidance and everything that is issued. It's all there in one place in one portal. So you can also look at what is it, how does it apply to real estate, how does it apply to financial services. They have given detailed guidelines on each of them. So ministry here is very, very forthcoming, and they have all the details on their website which are freely available for everybody to look at. And similarly, we expect for even corporate tax, some same thing would come up, and FTA would keep issuing that in due course. Yes, we will take effort to compile it if Jai Saab wants.
Sir, we will do something about it.
And one question yesterday also we are receiving, like Indian chartered accountant don't want to move from India, but they want to work for UAE or Dubai or Abu Dhabi. So for outsourcing opportunity, how they can find or they can look after, or how they can approach basically to the firms or directly to the businesses.
Hey, bye.
Okay, देखिए ये वो वाली बात हो गई. I mean, when you are saying this, it's like I want to eat sweets, but I don't want diabetes. Yes, you want to do outsourcing, I can understand, and there will be opportunities, but let the law evolve. Let something happen right now. It's still in the news, I mean, nascent stage where we are trying to decode the law. You can try to reach all the firms. If you see right now, if you go to your LinkedIn, you will see all the firms putting on corporate tax. Please start connecting with them, create that synergy with them, so that when they need hands to execute their assignments, they go back to you. Yes, there will be a time when the assignment will be so much that we cannot do everything sitting in UAE, and that time we will need hands. So you have to create that synergy with your partner firms, with your firms in UAE, and build that network. That will help you to do it. But you have to wait for that opportunity. You have to build that trust right now. It cannot be on day one. Today you reach out to me and say, Jay, I need that outsourcing activity. Obviously it will be difficult, right? You have to create that synergy. So create that synergy. It's right time. Maybe in 6 months over time, our hands are tied and we need more hands. All of you can help us. That's my take on it.
Yeah,
right,
you have
right.
about
Thank you. Yes. So thank you, Jai Bhai. Thank you, Tirupat sir. Thank you, Nirav Bhai. Before we sign off, we would like to request all the attendees to connect with all our panelists on LinkedIn, which all are very active on LinkedIn, and also in entire UAE. The LinkedIn is LinkedIn is also a worldwide network of professionals. So you also should be active, but particularly UAE are all the professionals are very active. Our chartered accountants are also very active there. So would like to request everyone to connect all our panelists to your network for a long-term association. This webinar is over. This 2-day session is over, but our long-term association will really help as a mutual benefit to everyone here. So with these remarks, we can conclude our 2-day session. Thank you all the panelists. Thank you Tirupat sir. Thank you Jai Bhai. Thank you Nirav Bhai once again for the entire making of this session, and very nicely presented. I can see many comments also for a wonderful session. They are also giving a formal vote of thanks, I would like to say. Fruitful session. Thank you. Thank you. Very clear, concise presentation. Thank you so much. So all the attendees are also having a same view, and they are also giving a vote of thanks to all the panelists. Thank you
No,
once
thank
again.
you, Virat, for organizing this. And if in future, once the law evolves and we want to do it again, we can also look at it that way. But sure, it was great to share the details with all of you. So just to make you all more aware, and we'll continue to do that. Thank you all.
Yes. Thank you, sir. So
Thank you.
surely once the regulation and all this comes up, we'll surely announce entire course curriculum kind of thing also. This is the awareness session, but in detail, entire law, how it will be actually working, that also we will plan once the regulation will out. So be connected with us, guys, and we'll have a more knowledgeable session for you all the attendees. Thank you. Thank you, Jai Bhai. Thank you, Tirupat sir. Thank you.
Thank you.
Thank you.
Bye. Good night.
Thank you. Good
Good
night.
night.